Hey everybody, this is Richard Lackey again with Trade Oracle Group. Glad that you could drop in. We're going to do a four-part series on why hedge funds make money and you don't. It's a little bit pithy, admittedly, but there's a lot of things that most investors and most traders don't realize about how markets work and where there are distinct advantages in the markets that some people take advantage of and others completely miss out on. And this gives them the opportunity to make better than average returns with a lot less risk. Many of those are taken advantage of by hedge funds. So we're going to talk about that. Some of those are perfectly moral, perfectly ethical, just things that you didn't know, but now you do. The other ones we're going to talk about are actually questionable, and in my opinion, probably should be made illegal. And we're going to get into a little of that in our later discussions. If the series goes well, we'll do more. But I wanted to start with one in particular. Before we get started, though, I want to make sure that we go through the required disclosures. You can read this on your own. A copy is available. You can slow down your video. But the bottom line is anything that we talk about that has to do with past performance, there's no guarantee of future results. The opinions presented are my own. They can't be viewed as an indicator of money that we manage or any future performance or what have you. We're not trying to sell you anything. We're not trying to pitch you anything as far as money management or that sort of thing. We are going to share some of the tools that we use to manage money and to trade profitably. But that's completely separate from managing your money. We're not planning to touch that and not asking to. We're based in Littleton, Colorado, beautiful area in the foothills just outside of Denver. And we've been here for a number of years and live here primarily because of the quality of life. If you want to come visit sometime, we'd love to see you. The hedge fund advantage. This is where we're going to start. There are four areas we're going to talk about, one in each of the four segments. The first one is that we can push markets. Hedge funds, when we say we're talking about hedge funds, where we want and when we want for at least some period of time. And I'm going to use the example today of opening market gaps. So hedge funds can't push the markets. If you don't believe that and you want to pay attention to just the simple constructs of modern portfolio theory and the efficient market hypothesis, which went from strong to moderate to weak and so on and so forth, the semi-strong and the weak. They keep adjusting the model because each one is so easily to prove incorrect that it basically has very little value for folks that are interested in outperforming the markets. If you are not interested or don't believe that you can do that, then you should just look for the lowest cost mutual funds and the lowest cost advisor and not worry about adjusting your portfolios once a year or once every 10 years because there's no advantage in it. Just put your money in the S&P and a group of 10 different sector funds and be done with it. We believe you can push the markets, partly because we've been doing it for 20 plus years. And most of the beautiful homes outside of Chicago are from people that have been trading on the floor for years and years. And they know that there's opportunity by trading for shorter periods of time. We also know that there are hedge funds, the top 10 of which have billions and billions in assets under management and consistently outperform the market because they have a statistical advantage or they know something in the marketplace. Some of those funds actually use this ability to push markets. They can push them up or down for a period of time. I know this because I've done it. I've been one of those people that's literally pushed markets around for some period of time in order to take advantage of it. I'm going to share one of those concepts with you now. It's used predominantly by institutional funds, but you can do it in your own way in some fashion if you know the right stocks and how the market is played. So let's start off with what we call opening gaps. If the market looks like it's going to do really well in a particular stock, and I run a desk and I'm in charge of that, and I have, for example, 20 stocks in my box. If I'm an institutional trader, I may have 12, 15, 20, 30 stocks that I'm responsible for making a market in. So if I'm a market maker and I'm looking at those and I think the earnings are going to come out strong for this stock tomorrow or later this morning or whatever the case may be, what do you think that I do when I'm trying to buy as much as I can? When I'm managing money either for a group of high net worth people or for funds that are trying to add more money every month with dollars coming in and they want to increase their position or they want to maintain their percentage position in those stocks, what do? Well, we come in prior to the market open and we push the market down. So we'll go low offer, 1,000 shares, drop it down 50 cents or $1, and drop it down another 100 shares. I'll keep going low offer, low offer, and people may buy it and I'll keep replacing it. In the meantime, I'm going in through one of the ECNs, the electronically controlled networks, or another firm, and I'm buying 2,000, 5,000, 10,000, as much as I can. And my goal is to buy 10 or 20 times the volume of what I sell short. I'm buying it back exponentially larger, and I'm building that position so that when the market actually does open and it bursts up, that I've got a much bigger base on which to build. So I'm artificially compressing the market with the hope that it's going to gap. That is an opening. That's a pre-market gap. The opening gap is almost the other way. When the news is good, now all of that I bought, say I bought 200,000 shares, I only need 100 or 150,000 shares. I will keep pushing it up, and whatever extra bit that I can get, then I start slowly fading that and selling it out and taking that profit, and I book that. And so when I do my reports, I show that that's the number of dollars that I made for the day, essentially by pushing it down, compressing that spring, and then letting it pop and selling it off. That's an opening gap. If you want to make money trading an opening gap, watch the trade volume, watch the size on the offer and what gets printed. Watch who's doing it. If it's a single group, Morgan Stanley, Goldman, whomever it is, and they keep dropping, that trader is typically looking not to sell off because he's scared. They don't get scared. It's not their money. They're typically looking to sell off enough that they can buy much larger volumes at a lower price. If you do that, wait for that to slow down. And when the volume starts picking up, or the numbers go from odd lots to larger lots, then back to odd lots again, and it starts thinning out and there's more people buying than there are on the sell side, on the bid side, then you need to start buying yourself, lift that offer yourself from that market maker. And then you'll notice that sometimes just a few minutes before, sometimes it's 30 minutes, sometimes it's 5 or 10 minutes after the open. Sometimes they'll keep it compressed all the way through the first few minutes of the open. Then it will spring back the other way. Trading gaps is a great way to make a fairly significant amount of money in a short period of time. You need to watch the same symbols again and again and again. And you'll notice that there are a lot of times that either on earnings or on Mondays or whatever the case may be, that they regularly have these moves, and then all of a sudden they gap. They have moves and then they gap, have moves and then they gap. And that happens on a regular basis because that's the strategy that market maker uses again and again. Just stand in that gap and ride with him when he or she does that. It's a great way, like I said, to make dollars if you're patient enough. If you drop in $2 and buy it and they drop it in another $1 or $2, you need to be comfortable with the amount of shares that you have, that you're comfortable taking that kind of pain, because oftentimes they'll keep on dropping it before they let it spring back. I'd also suggest that you have tools that let you know what the general pressure in the market is. And we use a tool called Flow, which gives you an understanding of what the pressure is in the market at each time frame. And much like the wind blowing, it may blow one direction at 500 feet, and then you get to 1,500 feet, it blows a little different. And then it gets to 4,000, it's blowing the opposite direction at 300 miles an hour. It's the same thing with markets. Stocks move, and commodities move, and futures and even crypto move at different paces and with different patterns based on different time frames. So on one time frame, it'd be maybe one pattern, and on the next time frame, it may be different. With a tool like Flow, you're able to see what all of those are at each of the different time frames. And when they're all synchronous, when they're all working together, it's really, really powerful. Our goal here at Trade Oracle Group is to create a network of well-educated, active management supporting professional advisors, one. Number two is to empower traders who really want to consistently learn to make money, or already do, and they just want to make more. And with the kind of tools that they need to be able to see the market in multiple time frames, and to be able to find the stocks to trade, the commodities to trade over what time frames, and be able to manage their risk and to hold on to their winners longer and cut their losers short. So we do this through education, and we do this through creating a movement. And we hope that that will come as part of our ongoing educational efforts, as well as folks joining us in our chat room and what have you. So we invite you to join us, check us out. You'll see different software technologies and what have you. Flow technology here that you can see, the red line is predicting what's going up. So it literally tells you kind of the oscillator value or the price movement in the historically, and the green line is what was predicted. The yellow line is what happened. The red line is what is now predicted. And it gives you an 82% confidence interval that the following data will be within inside of those two blue bands. That's a fairly high confidence interval that gives you the confidence to trade over multiple time frames. And you can see this same chart on the same stock or the same commodity for multiple time frames. And it may have a little different look, but it allows you to get a feel for where the market is going, and to trade more effectively. The phase technology is coming out soon, and I'll show you on the next page, but the phase technology essentially aggregates every commodity, every futures contract, every equity that we look at. So it's thousands. And it tells you which ones are most likely to go up over the next 3 days, next 3 weeks, the next 3 months. And it gives it to you by percentage so that you can, because that's what really matters at the end of the day, is what you did on a percentage wise basis. So this isn't exactly the way phase will look, but it does give you a little bit of a feel for what information it does carry. We also have a signal technology coming out for those people who don't have time to trade on a regular basis, and it just takes advantage of our flow technology and our phase technology by giving you the signals of what to buy. Typically, it includes some medium-term day trades and some swing trades, and that will be launched in the fall. Here's a good example of how you compare AMC stock, for example, had these cycled movements up. You can see that in here, and then it predicted that it was going to fall down, and it did. Stopped right there and turned, and when the bands widened out, it actually flattened out a little bit, and then it fell again. Same thing with Pfizer. You can see that the patterns moved inside the bands, moved to the band, and then as it started turning down here, you see that it turned down and fell apart. This is what flow does. And again, it doesn't tell you the exact buy and sell. We have other technology that does it, but flow is a great way if you're a trader to keep you trading in the right direction and to stay in trades longer so that you can make more money. The phase technology, this is just a picture here. You can see that it's got the long sector choices, the short sector. It's got currency, long and short, global indexes, and so on and so forth, fixed income even. But our goal, all in all, is to help traders and advisors solve the big challenges. So they're not taking too much risk, which sometimes just holding a portfolio, the risk varies, right? If you stay in the same portfolio, stocks move way up and there's air underneath them. And if you don't adjust because the PEs change, what have you changes, and you don't adjust that portfolio dynamically as the market changes, you begin taking on more and more risk for sometimes less and less upside opportunity. But learning how to limit the amount of risk exposure that you have at any given time while maximizing the opportunity for gain, that's what we're looking to do. And we also know that that opportunity comes from having those three things together. One is education, and the second is community, and the third are trading tools that give you an advantage, or some strategy that gives you an advantage. So that's what we do at tradeoracle.com. Appreciate your letting us give you that little pitch on it. But we'd invite you to join us, sign up for our free newsletter, join our chat room, and try out Flow. Thank you so much. If you want to get a hold of us directly, feel free to email team@tradeoracle.com. If you want to speak with me about something specific, you're welcome to email me at tradeoracle@protonmail.com. Thank you again for allowing us to share some time with you. I hope that you got something of value, and look forward to chatting with you again. God bless. Bye-bye.